So, Howard, welcome.
Thank you.
So I've really thought hard about how I got to, actually introduce these guys, and I hope I do a good job. And I'm going to start with Bob Steers, Executive Chairman of Cohen Steers, Cohen and Steers. Bob co-founded Cohen and Steers with his partner, a gentleman by the name of Marty Cohen, back in 1986, where they really pioneered the REIT mutual fund strategy. Early in his career, he worked with Citicorp, which is going to play into our story here a little bit, but that's where he met Marty. And fortunately for us, he graduated from Georgetown University's undergraduate business school and has been an extraordinarily loyal son of the university. And I'm always really proud. I've really worked at two places in my life, and I've been proud to work at both of those places. And I'm always proud when I say I work at Georgetown. One, I love the institution, but two, to say that I am associated with the Steers Center for Global Real Estate because of the quality of Bob Steers. He's of the finest quality, and we're very lucky to have him at the head of our ship here. So, and to his left is Howard Marks. He is the co-chairman of Oaktree Capital Management, and man, I'm really privileged to have the opportunity to introduce him. Originally from Queens, New York, Howard went to Wharton, where he pursued an undergraduate degree in finance, graduated cum laude, then went to University of Chicago to focus on accounting and marketing, and he picked up a CFA as well. He was also at Citicorp for about 16 years. He was the director of research and the senior portfolio manager who oversaw convertible and high yield debt. He joined TCW in 1985, where he was until he co-founded Oaktree Capital Management in actually 1995 with partners from TCW. Now, there's tons of videos with Howard speaking, and I saw one of him from 2015, which really spoke to me, and he referred to himself as a teacher. And that really resonated with me because I think we've all read his memos to clients over the last 30 plus years, and he's teaching. They're very long lessons, but they are definitely some of the best learning and teaching you're likely to see and read. So that spoke to me. And at Georgetown, we talk a lot about value of an asset and its price, right? And so oftentimes a student will say, well, I don't like this investment. I'm like, what if I gave it to you? Assuming there's no environmental issues or something we don't know about. I'm like, yeah, I'd like that. So it's a price issue, right? So our students are very lucky at this point in time to be able to have the opportunity to listen to Howard Marks. So with that, I'm going to turn it over to Bob Steers. Thank you very much, both of you guys, for being here. We appreciate you.
Great. Thank you for that, Matt, and thank you for the NTR panel. I think this is a particularly exciting time to be gathering here. We've had a day and a half of board meetings filled with real estate investment professionals and students trying to figure out where we are in the cycle, whether it's real estate, the economic, or interest rate cycle. Under the category of better lucky than smart, Howard first said yes to Luminaries 3 years ago, and then COVID hit, and that was that. And so we've been waiting for the opportunity to get back together again. And I would venture to say that this is one of the most uncertain times for a lot of these things that we've seen in quite a while. So I think it's really an exciting time to have someone with Howard's experience. And I would add to the introduction that Matt had, Howard's really been a pioneer in many ways in the high yield space a long time ago. As Matt said, founder of Oaktree. I think, Howard, you've also spawned a few other money managers, such as Double Line. And I will give you an assist on Cohen and Steers. Howard hired Marty and I, gave us our first jobs out of graduate school in 1977, about 45 years ago, as lowly equity research analysts when you were director of research at Citi. And so thank you for being here. thank you for the many contributions you've made to the asset management industry. So, given the environment we're in, I think we have a lot to cover, maybe more than we can cover. I'm thinking in terms of three broad categories. I think many in this room read your December letter entitled Sea Change. And I know our firm, and I think many in the discussions that we've had over the last day and a half, agree there is a significant, we're in the midst of a significant regime change. Interest rates, capital flows, potentially liquidity, the banking system. So I'd love for you to share your thoughts on that you articulated so well in your Sea Change letter. We obviously want to spend some time on commercial real estate, especially in the rates are going to be higher for longer, and what does that mean for the industry? And lastly, if we have time, talk a little bit about higher rates, commercial property impact on the financial and banking system. So, but before we get into that, particularly for the benefit of the students in the audience, I recently heard a personal story that you told about your initial job search, which was somewhat shocking to me, and there's some lessons to be learned from that. So if you wouldn't mind sharing that, that anecdote.
What Bob's alluding to is the fact that when I was getting out of Chicago in 1969, I knew I wanted to go into finance, but I had no idea what I wanted to do within finance. I really did not have a leaning. And so I applied to 6 jobs in 6 different areas: investment banking, investment management, public accounting, corporate accounting, consulting, etc. And but I was kind of indifferent between the 6, in part because my knowledge of them was superficial. But there was one that seemed more prestigious and more glamorous than the others. So I said, well, if I get all 6, I'll take that one. And that's the one I didn't get. So 30 years later, the guy from that firm who was the campus interviewer did something auspicious for Chicago. And I wrote him a letter and I said, I don't remember, I don't know if you remember me, but I interviewed with you and I didn't get that job, but I want to congratulate you on what you've done. Now, this was the days of letters. So that means it took him a week to get it and a week to answer, and then I heard from him a week after that. And I get a letter from him. It says, of course I remember you, and I followed your career, and you've done great. And by the way, if you ever want to know why you didn't get that job, give me a call. So now it takes about 10 seconds to grab the phone, and I call him up, and I say, well, thanks, Eric. What's the story? He said, well, it's simple. We hired the wrong guy. I said, oh, you know, you're sweet to say that. He says, no. He says, I don't mean it like that. He says, I mean that all the recruiters voted to hire you, and when the partner came in that morning, hungover, he called the wrong guy. and they actually gave the job to my roommate. And this is a true story. And I said, but I talked about this in a memo I wrote in 14 about luck, because I said that if it wasn't for that stroke of bad luck, I could have spent the next 40 years at Lehman Brothers and ended up with nothing to show for it. So the real lesson is...
So literally, Lehman Brothers was the job you didn't get.
That's the job I didn't get. And so what it means is, you know, there's an old saying that man plans and God laughs. You don't ever know for sure what the right course is, and you don't know what to hope for. And you kind of have to roll with it, don't you, Bob? And I think the great philosopher Shaquille O'Neal was experience isn't what happens to you; it's what you do with what happens to you.
Well, I hope the students in the audience there get the message. I think it's a good one. All right, so let's get down to business here. The sea change memo that you put together, I thought was provocative, and I won't steal your thunder, but it threw out lessons from the past about investors who get enamored with a particular strategy, type of investing, FANG, FOMO, memes, all those types of things. And if we really are pivoting or in a regime change here, I think it would be helpful to think about what that could mean and what does the next regime look like.
Sure. Before I answer your question directly, Bob, I want to respond to something you said at the very beginning, because you said this is a particularly uncertain time. And in my experience, there are two kinds of times. There's the times when you know what's going to happen in the coming 10 years, and the times when it's uncertain. And the main difference is that the first time, you're wrong. If you think you know what's going to happen, you're wrong. And that's kind of what my experience showed. And, I wrote a memo in October called The Illusion of Knowledge. And I quoted the historian Daniel Boorstin, who said that the enemy of knowledge is not ignorance, it's the illusion of knowledge. When people believe they know and present themselves as knowing, it interferes with exploration. And maybe the other way of saying it is what Mark Twain said. He said, it ain't what you don't know that gets you into trouble, it's what you know for certain that just ain't true. And so I would say right now, Bob, we don't know anything for certain. There have been other times when we did know for certain, and we were wrong most of the time. But anyway.
But it does seem that we've been through 40 years of declining interest rates, and at least 15 since the financial crisis, and that's ending. And there is this great unknown now.
Sure. And I say in the memo that in 1980, I had a loan outstanding from a bank in Chicago, personal loan, at 3/4 over what was called prime at the time. And I would get a slip, crudely generated slip from the bank each time the rate changed. And I have framed in my office the one that says the rate on your loan is now 22 1/4. December 19th of 1980. 40 years later, I was able to borrow at 2 1/4, fixed for 15 years. So this was a massive change. And whereas I assert that I don't know much about the future, the one thing I'm sure of is that rates are not going to go down by another 2,000 basis points, right? And so if this massive period of decline is over, then the question is, what does that imply for all the things we do? And as Bob says, it was the 40-year decline from Fed funds rate of 20 to 0, and then more recently, again, the Fed set the Fed funds rate at 0 at the beginning of 2009 to pull us out of the global financial crisis, left it there for 7 years for some reason that I find inexplicable, and kept rates basically low from the beginning of 2009 through the end of 21. And those 13 years are the subject of that I explore most in the memo. And of course, this was facilitated by the fact that despite the high level of stimulus from the 0 rates and quantitative easing and the resulting decline of unemployment, we still didn't have inflation in that period, which permitted the Fed to maintain that regime of low interest rates. That's, in my opinion, what's over. Now, I'm not saying that rates, having come down, are going to go back up. I merely say they'll probably kind of skate along here. Anybody who joined the industry in the last 15 years probably thinks we're in a high interest rate environment today.
Right.
But we're not. We're in a normal interest rate environment, I would say, largely normal. And I think so one of the tenets of Oaktree's investment philosophy is that we don't predicate our investments on macro forecasts. We don't believe in macro forecasts, especially our own. And so we try, but interestingly, you have to have some thought about the macro environment in order to make a prediction, and you have to predict earnings, cash flows, whatever it might be, in order to be able to buy an asset. So, but the answer is that we make neutral assumptions. And today, I think the neutral assumption is that rates stay where they are.
So what do you do with that? Do valuations revert to some historic mean? What happens after 15 years of your 2% loan?
Yeah. Well, I mean, for every basic interest rate, there's a range of appropriate discount rates or whatever cap rates, whatever you want to call it, for every asset. And the cap rate that is a friend of mine bought retail on Fifth Avenue 10 years ago at 2.5 cap rate. I dare say that's not. I dare say that's not appropriate today. Right. What is it for that property now? 7 or 8? Yeah. Okay. But anyway, the other thing is one of the most important lessons is never confuse brains with a bull market. And I was talking to Bruce Karsh, my partner, 2 days ago. We had a call with a client. We're talking about this thesis. And when I got off, I called Bruce and I said, what occurred to me is just think of somebody who had the idea to buy an asset, whether it was a property or a building or a company, within the last 15 years, and went to the bank and bought it with borrowed money just before having interest rates decline steadily. You'd have to be seriously deficient person to lose money, because the declining interest rates make every asset more valuable, discounted present value of future cash flows. When the discount rate declines, the present value increases. And then you borrowed money, and every time you had to renew your loan, it was at a lower rate. How could you not make money on that basis? This was a great period for people who owned assets, great period for people who borrowed money, and a double bonanza for people who bought assets with borrowed money. But if that's changing, if rates are done declining, then you have to know that.
So, and I think I want to save the real estate questions for a little bit later, but so some of us have done the math on, so rates stay the same, the $4.5 trillion of mortgage capital out there is going to refinance at the new rates, and there's projections that to maintain current loan to values with these higher rates would require an additional 500 to 600 billion of additional equity capital. That's just in real estate. I want to focus on the broad economy and markets. Right. If you believe that that where we are today is not only the old normal, it's the new normal, and it's going to maybe be higher for longer, maybe forever. Have you or Oaktree thought through, okay, so like the real estate example, if that flows through the economy, and I'm particularly concerned about away from real estate, I think more money's going into private equity, financed probably with leveraged loans, 3 or 4 year maturities. Mm-hmm. We don't have any way of tracking that. In real estate, we can track. We know what's going on there. If those loans are upside down, mm-hmm. What is the impact on the economy, on the market, stock market, on the banking system?
Sure. Well, I put out a memo last Monday about the banking system, called Lessons from Silicon Valley Bank. And I don't think that the bank is threatened. The banking system is threatened. I don't think it's comparable to 2008. In '08, we saw Merrill, Bear Stearns, Wachovia Bank, Washington Mutual, and ultimately Lehman either disappear or require rescues or be acquired. I don't think this is as thoroughly taken up within the financial system as were the subprime mortgages and the relating RMBS. And of course, remember that the banks at the time were making so much money from packaging mortgages into RMBS that they would buy the bottom tranche in order to facilitate the process. Right. So, and I don't think that the banks own the bottom now. I think they own the top.
Yeah.
I don't think this
I'm not
is
concerned about the banking system either,
okay.
but
Well,
the
look,
impact on the economy.
Well, people are going to lose money because when Bob talks about it requiring $500 billion of equity capital to re-equitize the real estate industry, and let's say a similar amount for the private equity industry, what he omits to say is that the old equity might be gone. Somebody's going to eat those losses.
Right.
And Oaktree's greatest business is investing in distressed debt, and we started that in '88, and it's been a great business for us. But it's mostly predicated on the fact that even good assets can get overlevered, and if they're overlevered, the probability of getting through a rough patch declines. Your ability to get through a rough patch is all else equal, is proportionate to the amount of equity on your balance sheet. And of course, when things are going well, people disregard that and they go for the highest leverage they can get because, as they say in Las Vegas, the more you bet, the more you win when you win. So what we do is we buy the debt of those over-leveraged companies when they suffer difficulty, and we do it with properties too, because not everybody's going to put in their share of the $500 billion, right. And not everybody has it to put in, and people let things go, so there'll be losses, and throughout the economy, certainly throughout the investment world, and that will, have a deleterious effect on everything, and it'll seem, you think it's uncertain now. When that happens, everybody will be certain that it's going down the drain. Right. But of course, it never does. And remember that I think the global financial crisis was much worse for the financial system than this is, and we got through that.
Well, what do you think this is?
Pardon me?
What do you think this is? A plain vanilla recession, typical cycle? How does Oaktree or you think about it?
I think it's going to be a moderate recession. And by the way, that's one of the many forecasts I don't believe. But nobody thinks it's going to be an economic cataclysm. Among other things, if the normal description of a cycle is boom bust, we didn't have a boom in the real economy. Right. We had the longest economic recovery in history of exceeding 10 years during this period I'm talking about, but it was also the slowest. So we didn't have a boom. Where you had excesses, perhaps were in leverage finance, and so equity investors will lose money, and junior debt holders will lose money. I think that's what's going to happen.
So, are you excited, for the, transitioning from a decade where growth did well and value did not, and feels like we're rounding into the perfect opportunity zone for Oaktree?
Well, I don't want to jinx us, but the truth is that the period I described. Look, if you look at '09 through '21, you had low and declining interest rates thanks to no inflation. You had a healthy economy stimulated by the Fed. You had a paucity of defaults and bankruptcies. You had no real fear. The greatest fear was the fear of missing out. Nobody was afraid of losing money. You had happy asset holders, eager buyers, easy access to capital. So you put that together, that's a pretty glowing period. And of course, the trouble is that idyllic periods like that encourage risk-taking.
Right.
So people push up their LTVs and try to limit their equity,
Sure.
and they become willing to engage in riskier assets. You know, and one of the interesting hallmarks of the last 15 years was, you know, prior to 15 years ago, I think you couldn't issue a bond for a company that lost money. And in the last 15 years, it became possible. Prior to 15 years ago, the private equity industry, for the most part, would not invest in technology or software. And then they said, well, maybe it's okay. And so you have a lot of tech and software that was the subject of LBOs, for which a lot of debt was raised. And, you know, these things will be tested. Buffett says it's only when the tide goes out that we find out who was swimming naked. And the tide, we believe the tide will go out. So, so we're very optimistic.
Yeah.
The 13 years I'm talking about were a tough period. Well, it was a great period for asset owners and borrowers. It was a terrible period for lenders and bargain hunters, which is what we are at Oaktree. That's what we consider ourselves to be. And, you know, the distressed debt funds, 35-year record, gross return of 22% a year, unlevered. Now, if you can make 22% a year on unlevered investments, it gives you a sense for the bargains we were able to secure. That's how you make that kind of money. The value investor, his goal is to buy things for less than they're worth. Makes perfect sense.
Yeah.
They're most commendable, right? But the trouble with that is that it requires the cooperation of somebody who's willing to sell an asset for less than they're worth. And that happens in the bad times. That happens when people say, you know, I bought it at 100, it's 50 now, I got to get out before I lose the other 50. You know, and things will never get better. That was not the case in the 13 years. So we had a hard time accessing bargains, and the funds in that category, for example, had the worst stretch ever. Now, they all earned at least 10, which is not the worst thing in the world, but it was far from our long-term average. Now we think we have a shot at the long-term average again, because we think that there will be motivated sellers, forced sellers, and you know, those are the people you want to buy from.
So you're saying that we're entering the 20% zone?
For us, yes, I think so.
Really?
Well, I think so.
And are we there now, or you think we're getting there?
We're not there yet.
Right.
You need desperation.
And how will we know that when we see it?
We'll be buying. No, I mean, look, I actually argue for an activity that I describe as taking the temperature of the market. You have to assess the mood of the market participants. Are they happy and celebrating and, you know, putting down orders at the Ferrari dealer? Or are they, you know, hunkering down and, you know, telling their wives they can't go shopping? And we'll know, you know, we'll know when people are suicidal.
I don't think our real estate guys are quite there yet.
No. Well, you and I were talking before we started about denial, and
I didn't say that.
And well, look, and what happens in illiquid assets, you know, what happens in the liquid markets, the listed markets, is that prices collapse. What happens in the private markets is that there are no transactions, right?
Right.
Because the buyer wants a price which is commensurate with current conditions, and the seller hasn't accepted that yet.
Right.
So obviously there's no meeting of the mind, there's no transactions. And usually, after a while, somebody has to sell for any of a variety of reasons, and that's when the prices of private assets decline. There's been a big discussion of last year was one of the worst years on record for the stock market, and first or second worst year on record for the bond market, and maybe the worst year on record for the 60-40 mix of stocks and bonds, and yet most private investors didn't mark down their portfolios much, if anything. So there's been a discussion of the propriety of that relationship, and every private asset owner has an explanation for why they haven't marked them down.
Yeah, I've heard a few.
And I want to interject here that they're not all nuts, because the argument is that private assets have not shown enough volatility, but I would submit that public assets exhibit too much volatility. And when you mark your private portfolio, the decision rule can't be set a price which is commensurate with the doomsday thinking that's prevailing in the public markets. That's not the right idea either.
So that's a great segue. I'm going to move into commercial property. Mm-hmm. I hear you've been making the media rounds bad-mouthing commercial property, so we're going to delve into this a little bit. So I think we all acknowledge rates are higher, liquidity's lower. REIT prices were down 25% last year. Non-traded REITs were up. We had a discussion earlier in our segments that while, to your point, Howard, while the public markets are a pretty perfect leading indicator directionally, with regard to magnitude, as you say, they tend to overshoot and undershoot. So, but REITs were down 25% last year. Core was up. Bid-ask spreads are wide. Transaction activity has cratered.
Right.
I think cap rates are starting to rise, but it's hard to tell with a lack of transaction activity. Moving to the real estate mortgage market, $4.5 trillion market, about $700 or $800 billion matures each of the next 4 or 5 years. A third of loans are floating rate, and a lot of multifamily and some office. And again, probably need to inject $500-600 billion over the coming years to maintain loan to value. So I guess I'm asking what your opinion is of that market, and where do you see opportunity?
Well, I believe that, as I said before, when interest rates go up, the notional value of all assets goes down. And last year we saw the fastest increase in interest rates in history. The Fed funds rate went from 0 to 4.5 in 9 months. Never been anything like that before. And at the same time, psychology swings from, I always say that in the real world, things fluctuate between pretty good and not so hot. But in terms of investor psychology, it goes from flawless to hopeless. And, we're on the way. We've made nobody thinks the outlook is flawless anymore. I don't think anybody has accepted that it's hopeless, and I don't know if they will. But certainly, psychology is more moderate today than it was. So you have higher rates depressing value, you have a negative swing in psychology, and then in certain sectors you have a real deterioration of fundamentals, long-term fundamentals, maybe office. Right. And certainly, as you said before, certainly office that's not great properties. Old or ill-located or, right, or something like that. Now, nobody can say whether the 25% decline of REITs is appropriate, not enough, or too much. But anything which hasn't been marked down is suspect.
Right. In the financial crisis, the peak to trough for REITs, 72%. So if REITs are an indicator at all, to your point earlier, the magnitude versus 08, 09 is substantially different.
But those are publicly traded REITs. Yeah. Now, one thing I want to stress to everyone here is that if you looked at a chart of the economy over the long term, it would kind of look like this. It has a moderate slope and moderate fluctuation. The long-term average is 2% a year, sometimes 3, sometimes 1, occasionally 4, and occasionally negative. But it's kind of like this. If you look at a chart of profits, or maybe net operating income, it looks like this, right? Mm-hmm. The fluctuations are greater. Why? Companies and properties are levered. Companies in particular have operating leverage, so when revenues decline by 20%, profits go down by half, and vice versa. And then they have financial leverage, so that whatever the change in the value of the asset is, the impact on the equity is magnified. So earnings fluctuate much more than GDP. And then if you look at public asset prices, they go like this. What makes up the difference? How do you explain the difference between this kind of fluctuation in profitability and this kind of fluctuation in prices? Psychology. Bingo. Psychology. People go from flawless to hopeless. So clearly, the decline in the prices of REITs was overdone, right? And you went in and you bought a lot, and you made a lot of money.
Right. So
this is why he says grudgingly, but this is why we can't say whether the 25% decline in REITs is too much or not enough.
Right. So is Oaktree looking at commercial property, and would you invest? It seems like, and I remember this from back at when the energy market was in the tank, and you went around and talked to institutions, and nobody owned energy. And I heard on the panel today that everyone's been selling office for 10 years.
Nobody owns it.
So
they sold it.
They're waiting.
They sold it, but nobody bought it.
Exactly. Well, that's my question. So everyone on the panel said 3%. The office REITs only represent 3% of NAREIT today, of all the public markets. So who owns office?
You're much closer to it than I am. But
would you buy office?
Well, but this question, you said something about would people buy it? And you've given me a chance to respond to something that Matt said earlier. If I gave it to you for nothing, would you take it? And one of the things I talk about in the memo on the sea change is a change in the mentality in the investment business around 77, 78, which is when you went to work and when I switched from equities to high yield bonds. And prior to that time, the job of the fiduciary was described as buying high quality assets. And this is one of the reasons we both survived the Nifty 50. That's one of the reasons why the Nifty 50 did so well. They were considered great companies. And because they were so great, there was no price too high, which is the inverse of what Matt said. Matt said, maybe, is there such a thing as a price which is low enough? When I started with high yield bonds, which were really invented in 77, 78, Moody's defined the B-rated bond as follows: fails to possess the characteristics of a desirable investment. That's it, And when I talk to audiences like this, I say, I drove over here this afternoon. I got my car downstairs. I really don't need it anymore. I'd like to sell my car. And you have money. I know you have money. And you might be able to use my car. So would you buy it? But I say to him, but there's probably one question that you would ask me, hopefully, before you say yes or no, which is, what's the price? And Moody's was saying that for a B-rated bond, there is no price low enough. And the converse is, for a high-quality asset, there's no price too high. Both of which were terrible ideas, which now, and the first sea change that I lived through was the switch in that mentality. Because now, we don't say that the professional is somebody who buys high-quality or low-risk assets. Now we say, is it risky? How risky is it? What's the prospective return? Is the prospective return sufficient to compensate for the risk? That's what we do today. And, you know, if we were still living in that mentality where it's the job of the professional to buy high-quality assets, by definition, we couldn't have distressed debt funds because all the companies we've invested in were either bankrupt or considered certain to become so. How could you responsibly invest in those? Well, the answer is there's such a thing as low enough. And the problem, of course, is that there's no place you can look to find out what that price is. And that's when you have to use judgment. But everything we're talking about here ultimately comes down to judgment. Not algorithms, not formulas, not rules. Superior subjective judgment.
So applying that judgment to commercial property.
Yeah.
Do you or Oaktree have a view of what the opportunity could be? So a lot of your comments about sea change are backward looking and learning from history. You know, most everyone in this room has got to figure out a way to generate high returns.
Right.
And in commercial property in particular, you know, we're kind of in suspended animation here. The markets are clearly at a turning point or regime change. And I think no one here can predict where cap rates are going, where whether liquidity will improve going forward. But do you have a house view, and what is your view on the opportunity in property, looking out 3 years, not today, but
our mantra in investing in distressed situations has always been good company, bad balance sheet. If you can find a good company, well-run, good business fundamentals, good business model, hopefully good management, and it gets over-levered because it participates in an LBO, and then it fails to get through tough times, that's easy to fix. So, we've been successful in buying the debt of those companies, and then you take it through a bankruptcy, and the old owners are wiped out, and the old creditors become the new owners. And if you bought it at a low enough price, that's a good model, which is as opposed to bad company, which is hard to fix. So we're not a turnaround investor. Good company, bad balance sheet. And so in real estate, commercial real estate, today you have good assets which may be underwater, upside down, and will need more equity. And one way to do it is by buying the debt and equitizing it if the owners don't want to add more equity. And if you can convince yourself that the operating income is sustainable and the cap rate is high enough, you buy it, and on a restructured basis.
But it sounds like you're not as focused on properties versus recapitalizing companies. Is that right?
No. Well, my experience is with companies. We have a real estate division, but that's not me. But the same will be true in real estate. You find a property which is where the price has fallen, and the equity and maybe some of the debt looks like it's underwater, but you can convince yourself that the cash flows will be X, and the cap rate based on that cash flow is Y, and that's adequate to cover the risk. Then you buy it. Good property, bad balance sheet. But the question is always, what do you do about the things you think are bad properties?
Right.
And, on the one hand, it's easy to say that I think somebody once used the expression that for an office building on 3rd Avenue, there's no price low enough. But Matt would say that there is. And the question is, and the people who will get rich are the people who say there is a price low enough and we're there, and who turn out to be right. That's how you get rich, but don't forget the latter part. You got to be right. Merely buying things that have declined a lot is not enough. You know, you have to be right that there will be some cash flow. And I'll tell you, 20 to 25 years ago, Oaktree's based in LA, and there were a couple of buildings just a block or two from us, empty buildings, mid-rise office, empty, that you could buy for a song. The question was, what, are they worth a song?
Right.
What's an empty building worth? And an empty building that's obsolete in terms of its qualities, what's it worth? And it's really hard to say. And I keep coming back to the fact that there is no formula that you can apply. It's just personal judgment, you know. And Sam Zell is famous for having applied that personal judgment and taking big risks correctly. And you know, we don't hear as much about the people who took those risks incorrectly.
All right, I want to leave some time for questions, but I'd love to just get your take on, we've touched on it peripherally, the health of the banking system, you know, the impact of rising rates. Some have estimated it's reduced the value of financial assets by over $30 trillion. You know, we've had the SVB, CS signature. We were talking inside earlier. You don't sound particularly concerned about the health of the banking system.
I don't think that the problems are systemic, and you know, among other things, the banks usually take the top slice of the credit, and if they loaned money at reasonably conservative loan-to-value ratios and took the top, they shouldn't have widespread problems, I don't think.
Now, would you look at, I've heard from some that agree with your viewpoint, but hold out the likelihood that there'll be some individual regional banks that have, you know, idiosyncratic risk and made mistakes. So there could be some more of that. Would Oaktree look at a situation like that? And were you looking at, you know, CS or any of those?
Well, we you know, we're open to anything. You know, we have to convince ourselves that the fundamentals are sound, and that the price is low enough.
Right.
But we're certainly open to it. And by the way, the statistics, which I got from I think reasonable source, which was probably you, were that on average, banks above $250 billion of assets have 4.5% in real estate, and banks below $250 billion of assets have 11% of assets in real estate. Right. The banks above 250 have half their regulatory capital in real estate, and the banks below 250 have 167% of their regulatory capital. So clearly, and some banks are in worse areas, and some banks concentrated by industry and made inferior loan-to-value decisions and loaned too much to, quote, good long-term customers who are now gone. And, you know, some of them will have problems. There's no doubt about it. But I just don't think it's going to be systemic. And, you know, if you look at 2008, when we had Merrill and Bear and Lehman and others disappear, we still got through it. Those were much more important systemic institutions, and we got through it.
Right.
So I think we'll get through it again.
Any concerns, you know, getting back to private equity and how that is financed, any concerns about the CLO or leverage loan markets, which to me are somewhat opaque?
Well, they are opaque, and but they look at your market and they think you're opaque. But you know, you know, the risk is a function of the quality of the underlying assets and the amount of leverage. And, you know, so CLO tranches right now appear to be offering very high rates of return, especially relative to their ratings. And, you know, an A-rated CLO tranche out yields an A-rated corporate bond by 300, probably. People make a big mistake when they take the ratings at face value,
right.
You know, because, you know, in America today, I believe there are 3 AAA companies. Mike Milken tells me that during the global financial crisis, or just leading up to the global financial crisis, there were 16,000 AAA CLO tranches. So something was wrong, and we know which one was wrong.
Right.
So I just would caution everybody in the audience who hasn't had experience that you can't take ratings at face value, and you can't compare the rating on a corporate bond with the rating on a tranched security.
Right. Okay, Matt, we have some questions from the audience.
Yes, we do, actually. So, Howard, what is a belief that you hold with which you think a lot of people would disagree with?
Well, I haven't had anybody, you know, it's 4 months since I put out Sea Change, and I haven't heard anybody say you're right. You know, everybody knows what the history shows, that rates are down and the stock market's down and bond values, rates are up and stocks are down and bonds are down and it's harder to finance, et cetera. But I think that most people are still treating it as a normal cyclical fluctuation, which is different from a sea change. And if I'm right about the sea change, and if my view describes the next 5 to 10 years, then that's a very different story.
So another question here. So obviously your memos are very widely read, and you know Warren Buffett pays attention, of course. So how do you determine what is memo worthy?
You know, I try to write when things need explanation, and I try to write more when the world is roiled. You know, and I prefer to write when I think I see something that most people don't see, because I'm trying to add value. You know, and that's why I started the SVB memo by saying I'm not going to give you another history of SVB. I'm going to try to give you the lessons. To me, the most important thing is not what happened. The most important thing is what inferences should you draw from what happened, and what lessons should you learn. So
related to that, you obviously write a lot, right? And there's a lot, you know, that's a challenging process, just, you know, the writing of things. So how do you think about writing?
No, for me it's fun. You know, I always point out that if you look at the memos, there's almost invariably one published in September and one published in January, which means that I wrote over summer vacation, I wrote over Christmas. I'd rather write than not. For me, it's my creative outlet. You know, I get great pleasure from writing, and you know, it's easy to say that I get a lot of good put-ups for the memos, and that's my psychic reward. But in the first 10 years, from 90 to 2000, I never had a response. Not only did nobody ever say it was good, nobody ever said I got it. And I kept writing, I think, you know, for my own enjoyment.
So we have actually a really good question from a student currently. For young investors trying to you know, develop their subjective investing judgment, what is the best way to learn and grow?
Well, the best way to learn is by being wrong for a while. You know, you learn nothing from success. And my 2018 book was called Mastering the Market Cycle, and it talks about the economic cycle, the profit cycle, the psychological cycle, the real estate cycle, the market cycle, all these different cycles. And the last chapter is on the cycle and success. And what I say in there is that you learn nothing from success. What you learn is, I can do it, it's easy, I can do it again, I can do it with more money, I can do it in other fields, And I can do it without my team. And these are terrible lessons. And you know, the day I came to work in September of 1969 at Citibank's research department, if you would have bought the Nifty 50 that day, which career-wise I did, and if you held it for 5 years, these were the greatest companies in America about which people believed, number one, nothing could ever go wrong, and number two, there was no price too high. If you held those stocks for 5 years, you lost over 90% of your money. And that was very educational. And what I took away from that was the conclusion that it's not what you buy, it's what you pay. And that success in investing doesn't come from buying good things, but from buying things well. And if you don't know the difference, you're in the wrong field. And so you got to learn those lessons at some point in time.
All right, one more, and then we'll turn it back to Bob here. So, Howard, how do you think about Chat GPT in your memos in the future here?
Well, I wrote a memo about 6 or 7 years ago entitled Investing Without People. And I talked about index and passive, systematic and algorithmic, AI and machine learning. And, you know, when I went to Chicago, the professor told us that the statistics showed that most equity mutual funds did not equal the S&P before fees, and the vast majority lagged after fees. He says, why don't they just buy one share of every stock in the S&P? There was no such thing as index funds at that time, or indexation. And of course, Jack Bogle popularized it in '74. And now I believe that passive and index investing accounts for the majority of mutual fund equity capital. Not because passive results are so good, but because active was so bad. And so, you know, if you go back to when we started, you could go into this business, you could hang up your shingle, you could manage equity money, you could lag the S&P, and you could charge a high fee. The world's a smarter place now, and you can't do that. And that's why the money has flowed into passive funds. And by definition, on average, most people do average, and most people don't beat the average, which means they don't deserve high fees before fees, and they fall further behind after fees. So that was a flawed business model, which is in the process of being corrected. And that's why a lot of money has been turned over to, let's say, machines, something mechanical. And I still believe that there are people who have superior insight and see things better. And, you know, the future is not a fact. The future does not yet exist, and we can sit here today and predict it. The future will develop. And there are people, a small minority, who see the future better than others and who understand the shape of the probability distribution and whether the expected return compensates for the pitfalls that lurk in the left-hand tail. Those people deserve to do very well. The rest do not. And especially one of the crazy things that has changed during our careers is that now incentive fees, people getting 20% of the profits, is ubiquitous. And, you know, when you give somebody 20% of your profits, you're essentially giving them all the profit on 20% of your money. And that's pretty exceptional. And so you should only get that for exceptional performance. And the world hasn't really figured that out yet, I don't think. There are thousands of hedge fund managers and thousands of private equity funds, and they all get 20% of the profits.
Why do you think that is? I mean, the hedge fund industry has underdelivered as much as active long-only managers have underdelivered.
It's a long story, but I'll take a minute. In 2000, the tech, media, and telecom bubble melted down, and the S&P 500 was down in 2001 and 2, the first 3-year decline since 1939. And everybody lost interest in the stock market. The Fed took rates to 1 or 2, and bond yields collapsed, and people lost interest in the bond market. So most people concluded that they couldn't get the returns they wanted or needed from stocks and bonds, and that was really the birthday date for so-called alternative investments. And what did they turn to first? Hedge funds, because hedge funds did quite well during that period. And so hedge funds that used to be 50, 100, 200 million dollars received billions of dollars, mostly from the pension industry. Right. And people don't understand that an onrush of money changes everything. And I wrote a memo on hedge funds, I think it was around 2005. And I said, over the next decade, this is the only time I ever touched on hedge funds. And I said, I think the average hedge fund over the next 10 years will return between 5 and 6. And over time, people will get tired of paying 2 and 20 to make 5 or 6. Right. And Barron's called me 10 years later, and they said the return was 5.2. We'd like to do an article. And still, there are trillions of dollars in hedge funds today. So you tell me. I mean, and I've been on a number of investment committees at nonprofits. I still am. And the message I give them is very simple. There is no room in a forward-looking pool of permanent capital for an asset whose only virtue is that it has a very high probability of producing a low return. but people still own them. Yeah. Now, there's a lot of psychology, and I think one of the things is people feel that diversification is good, but I think Buffett would say that including a fund which is 80% likely to produce a 5% return is what he calls diversification. And he's right, of course. But, people, I think a lot of people say, what? The return's been rotten, but the day I sell it is the day it's going to start going up. I don't know why they do this, but there's still trillions in hedge funds.
It's shocking.
Yeah.
All right, my last question.
And as opposed to commercial real estate, somebody actually owns them.
That's right. It's like office.
Right.
Yeah. Just getting back to sea change and some of the comments you've made, besides opportunistic or distressed investing, where you obviously feel good about the return prospects, do you think as the broad economy and the markets digest the higher for longer scenario, that we're, broadly speaking, destined to go through a multi-year period of low or no returns?
I think
stocks, bonds.
Well, look, when
because you made the case when interest rates, started their decline 40 years ago. The S&P 500 during that time generated 10.5% annually,
right. Yeah.
And you could just buy the index. It was free money.
10.5% a year for 40 years is a lot of
40 years.
profit.
It's a lot of money.
So when rates go up, everything has to offer a higher prospective return in order to be at equilibrium with current conditions. And the main way you get to offering a higher prospective return is a fall in price. So there has to be a period of adjustment for ownership assets, whether it be properties or companies or shares. So we saw some of it last year, but there's been a substantial rally, and so my own personal feeling is that it's not done. But the other thing is that, as I said, that was a terrible period to be a lender. I think the current period is a better time to be a lender because a year ago, high-yield bonds yielded about 4. There was a lot of issuance in the 3s, and there was even an issue in the 2s. Can you imagine a high-yield bond that yields 2.85? But today, high-yield bonds yield, and leveraged loans yield in the upper single digits. That's a useful rate of return. It may go higher as the prices go down, but that's a good starting point.
Right.
So, I think that after 13 years in the wilderness, I think that credit investing is looking at much better returns. But someday ownership assets will get cheap enough that they're a place to be. But if interest rates are going to stay up, then there has to be a period of adjustment.
You'll come back and let us know when that time comes?
Anytime.
Okay. Thank you, Howard.